Okay, welcome everyone to another free webinar brought to you by optionslam.com. You should be able to see my screen. Here we go. Read the CFTC rule, understand it before you risk your hard-earned money in the markets. The disclaimer tells you that we are not licensed financial advisors. We are not registered investment advisors. We do not provide investment or financial advice, nor do we make investment recommendations. The webinars and the information is for educational purposes only. The trades that are illustrated in these webinars are not recommendations. I will be illustrating some trades in today's webinar. They are not recommendations. You take trades at your own risk. I am Marco. This is my email address, optionslam.com@gmail.com. Please feel free to reach out to me with your questions and your comments and your suggestions. We love to hear from you. I answer 99% of the emails myself personally. So let's get into this. What came first, the chicken or the egg? In trading options, we might ask a similar question. What comes first, the stock or the strategy? In other words, which do you do first? Do you find a stock and then apply a strategy, or you find your favorite strategy and then go find stocks to fit it? The answer can be either or either way, okay? You can do it either way. But when looking to trade a through the earnings release type of a strategy, I do have a preference. We want to evaluate a stock and then determine which strategy fits our expectations. If you have a specific strategy that you wish to employ, you can search a list of stocks to see if you can think it will work on any of the candidates in your list. Many people do this. Many people use OptionsLam to do this. I have done the same. You'll see that I have screeners set up to search for stocks that fit a certain strategy. But this can lead to forcing a trade on a stock that really may not be a good fit for that strategy. For example, many traders like to sell naked strangles or iron condors on stocks as through the earnings release strategies. We go on about selling premium as a through the ER strategy. Selling straddles and strangles are great strategies as they benefit more than any other from implied volatility crush. They can be designed to have a high probability of profit. Well, that is, a strangle can be designed to have a high probability of profit, higher than a straddle is, you can't really design it. It's a straddle. The only thing you can do is either you do it at the money or out of the money. Typically, selling straddles is done as a delta neutral strategy at the money. Strangles are also usually centered around where price is currently to coincide with a delta neutral mindset. They are guaranteed to benefit, almost guaranteed, 99% chance in my opinion, to benefit from the inevitable implied volatility crush that happens post an earnings release announcement. However, these strategies carry heavy risk in both bull and bear directions. They are undefined risk strategies. So I've seen many times when traders trying to force the naked strangle on stocks just because it checks many of the boxes and has a good win rate. Generally, right around 70%, the way most people trade them. You can even design them to have a better probability of profit by sacrificing some premium. But let's not get hung up on that. The problem is big losers. They are difficult, big losers that is, are difficult to manage financially and emotionally. Now, they're not impossible to manage, but they're difficult to manage emotionally and financially. Big losers. One big loser can wipe out the gains from many winning trades. One solution, use iron condors instead. A popular defined risk strategy. This also is a great through the earnings release strategy, but the same downfalls of the short strangle are true here as well. Lower probability than the short strangle. Lower probability of profit than the short strangle is associated with an iron condor, assuming the same short strike. Less profit potential compared to the short strangle because obviously you're buying some options as well, which takes away from the overall credit. And again, one big loser can wipe out the profits from several good winning trades. But at least, of course, it is defined risk. So back to the chicken or egg question. When trading through the earnings release type of earnings trades, now I distinguish earnings trades as three types. Pre-earnings trades, those are trades we put on usually a week or several weeks or many weeks before the earnings event with the intention of closing that trade before the earnings event. That would be a pre-earnings trade. Now, a through the earnings release type of a trade is when we put the trade on, we initiate the trade right before the earnings event. In some cases, just minutes before the earnings event. Or typically an hour or two or one day before, usually at the most, with the intention of taking that trade off shortly after the earnings are announced, whether that be the very next day or later that week, possibly hanging on for a bit of time in some instances. That is a through the ER earnings release type of a trade. And then finally, last but not least, is the post-earnings trade, which is wait for the earnings to come out. Now you got a clue of what's going on. Yes, you've given up the opportunity to sell into implied volatility crush, but at least you're not exposing yourself to that gamble of which way is the stock going to go. It's pretty much a 50-50 shot whether stocks are going to go up or down after an earnings event. Even if a stock or a company has good earnings report, we've seen it just very recently where stocks go down heavy right after a good earnings report, and vice versa can be true as well. A terrible earnings report, and then they come out with some kind of positive statement or some news in the conference call, or they give forward guidance that looks great, sounds great, and then even though the earnings report was bad, stock shoots up. But back to the chicken or the egg question. When trading through the earnings release type earnings trades, should I decide on a strategy and then find stocks to trade that strategy on? Or should I find stocks that I am interested in trading and then find a strategy to apply to each of those stocks? And it might be a different strategy for each of those different stocks. And very likely will be. I feel strongly towards the latter. Find stocks, evaluate them, and then determine, based on your evaluation, what strategy to apply. Evaluate specific candidates and then choose a strategy that fits each situation based on your expectations. Are you a bull or are you a bear? Or would a delta neutral strategy fall more in line with your expectations? Evaluating candidates for a through the earnings release trade. So we're talking about a specific type of an earnings trade. It's the through the ER trade. Go to optionslam.com and use the stock screener to get a list of candidates. Let's do that right now. My go-to screener is very simple. I call it the generic screener. I use it often here in these webinars. You can start with it and then add more parameters as you desire to filter down if the list is too big. Right now, the list isn't too big because we're kind of coming out of the busy part of earnings season. So the list isn't huge. So it doesn't. So the generic screener is really very suitable for right now. When we're in the very busy part of earnings season, and the generic screener brings up 3 pages of stocks to consider, then it's time to start using some of the other filters. So let's go to optionslam.com. Go to the earnings tab. Let's go to the stock screener. And my generic screener is saved. All I got to do is click it here. And it's very simple. Let me run it by you quickly. Notice that most of the fields are not filled out. Only a few. This first one is 1 week from today. I'm looking for stocks that are reporting earnings, and I chose this one. You can choose any one you want. I like to trade stocks that have weekly options, but you can choose one of these other choices. All markets, or you could be specific to a market. I choose all markets. Earnings volatility rating. I am not really interested for the most part in stocks that have an EVR below 1. Most stocks have EVRs between 1 and 3. Okay? 1 to 3 is where most stocks fall. Earnings volatility rating is something that is specific here, something that we created here at optionslam.com. We rate all stocks with an EVR. You can go to the help menu and learn more about EVR right there. Okay? We don't have time to get into that right now, but you can go to the help menu and learn more about the EVR right there. Okay? So then I have, you can change this on the fly. You can save a generic screener, and then you can change it on the fly if you think conditions warrant a change. Okay? But I chose stock price of at least $20. You might say, well, there's some stocks I'm interested in trading that trade for under $20. Fine, change it to whatever number you're happy with. You can even put a maximum number over here. You're not interested in trading stocks over $500 or whatever the case might be. So you can do, minimum and maximum. I've included all market capitalizations, but you can choose whatever. I have not specified a short interest level, but we've had webinars. You can go to the resources tab and go to the Option Slam webinars. I think it was about a year ago, maybe it was 2 years ago already, where we had several webinars about using short interest and short squeezes, and I think we had about like 3 webinars about that topic, and it's certainly valid stuff, but my generic screener doesn't include it. And then the only other thing I have in there is 2 million average daily volume. This is just a way to, and you can put any number in there you want, okay? If you want to be more restrictive, put a higher number in there. If you want to be more generous and let some low volume stocks in there, you might go all the way down to 500,000 minimum average daily volume, whatever you choose. So as I use my generic screener, I just click on that, and it gives me a list of stocks that meet that simple criteria, that are reporting within the week and meet those other criteria that I just went through quickly. And several are actually going to be reporting today after the close. AI, CRM, Chewy, CrowdStrike, Okta, etc. Those are the ones that are reporting today that meet that 2 million minimum volume, and those. Now I do get the information. What is the short interest level, but I didn't filter out anything because of short interest level. So short interest level is very, very interesting topic. But again, I would refer you back to the historical archived webinars to learn more about short interest trading. Okay, so here's our list, and what we'll do is I'm gonna right click. As I hover over each of these, I get a quick synopsis of some recent earnings related activity and results of how the stock behaved at the 4 most recent earnings events. Okay, but for more detailed information, I'm going to right click and open CRM in a new tab. We're going to pick on CRM and CRWD today. So I'm going to right click on both of those and open them both up in new tabs. So you see I got new tabs just populated up here. There's Salesforce and there's CrowdStrike. I can go to those pages, go to those tabs, and by default, I'm going to be on the earnings history tab. So there's a ton of information here. And first of all, there's a chart that you can just kind of zoom in, zoom out, and go back in time, and you'll see right away a green E means there's an earnings event where the stock actually went up after earnings. That's the one day. These little bubbles represent the 1 day reaction. What was the 1 day after the earnings event reaction? Up would be green, down would be red. So Salesforce, CRM, and then, let's see, I got to scroll down here so we can see the date there. Now you can see the date down here. So August 24th was a down event. The 1 day after, the November 30th was down. The March 1st was up. Although look what happened. It was a gap up, but then the stock sold off from there. If you look close, let's zoom in there a little bit. And then we don't know what the event will be today, This is not a prediction that it's red. Not showing on the screen very well for some reason, but it's not a prediction. It's just the default. It just automatically colors it red. I thought it used to color them green, but I guess I don't know. Who knows? It does what it wants to do, but then it will change to the proper color once the 1 day stats are in. So by the end of the day tomorrow, then that will change to a green if it was an up day. If tomorrow is an up day, the 1 day post earnings, it will change to green. If it's a down day, it will stay red. So that's the chart. And these charts, by the way, there's live interactive charts. This chart is not live. This chart is actually 1 day delayed. This is yesterday's. This candle right there is yesterday's candle. Today's candle does not populate. So if you want live charts, go to your brokerage or click on this link for a live interactive chart, okay? If you want a live interactive chart, you can get today's information. And these are highly customizable. This is all provided to you by TradingView, our partner, and very, very professionally designed and customizable charts. So without getting into all the statistics and going through all of the information here, I just want to say this is the earnings history page. Here's the price movement within one trading day, open, high, low, close, the final closing move of the day, the max move throughout the day in percentage terms. And then don't forget to take a look at where EVR is now. Current EVR is 3.6, but where has EVR been? All these bubbles represent the EVR of this stock in historical fashion. And you can see the EVR got very low on this stock. 1.6 I'm seeing down here. 1.6 looks like the lowest. Maybe a 1.4. Did I say 1.4? No, 1.6 is the lowest it ever got. And then it shot up here in 2020. This is not, I don't want to say that that's true of all stocks, that they all shot up in 2020. But you might see this as a common thing. But anyway, here we are back to 3.6. You can see 3.6 is where we hovered with the EVR for quite a few years back in the early years of this stock, and now it's back up to that point. This stock has gotten more volatile. It went through a kind of a quiet period. So anyway, let's go back here a quick minute. And so you go to this, we went to the stock screener. Now, once you have a list of candidates, which we have a list now, and I picked two fairly randomly out of that list, okay? Fairly randomly, I picked two stocks, CrowdStrike and Salesforce. So I picked those two out of that list for us to concentrate on today. And you can go to stock, then you go to stock specific pages. We just went to the first page, the one that comes up by default, which is the earnings history page. But what we want to do is we want to see all the stock specific pages to evaluate the personality of that stock. We want to start getting a feeling for how that stock behaves. We're going to try to look for a strategy to trade through the earnings event. So we want to get familiar with how this stock behaves as it has an earnings event and how it behaves and reacts to its earnings event. So, and don't forget to assess and make a note as to what the current EVR is, as well as the historical EVR. Where is this? Not just where is the stock now in its earnings volatility rating, but where has it been and where is it heading? What is the trend? It seems to be in an uptrend, doesn't it? It seems to be getting more volatile as we studied that chart. Earnings history page provides a ton of information as to how the stock behaves with a focus on the one trading day post ER. Determine next a directional bias if you can. If you can determine a directional bias for your stock, I would say to you that the biggest winners, the biggest winning trades are those that are directional in nature if you're right about direction. That's the catch. You have to be right. And that's why I don't trade a lot of directional strategies, because I happen to be wrong 51% of the time, maybe more than that. So I'm not good at predicting the future. And my what yeah, my prediction ability is not something that you'd want to bet on. So go to the trend analysis page at optionslam.com for a technical look at your stock via Ichimoku analysis. This is a technical analysis which we just recently had some webinars on Ichimoku. We had a guest speaker, Leonard, who's probably here. He doesn't usually miss a webinar. And anyway, we've got, again, go to the historical webinars in the archives found under the resources tab to learn more about that. But I'm going to quickly just jump back to OptionSlam and show you where that is. And so once I go to, now remember, here's our list from the, let me get that pop up down, from the stock screener page, okay? From the stock screener page, we got this list of stocks. Then we found CRWD and CRM, and we open those in new tabs by right-clicking and opening new tabs. And then now I have both of those stocks, and now the black bar changes to become stock-specific pages. So all of these links are pages specifically for this stock. So next, after earnings history page, I can go to the trend analysis page. A new chart pops up, and it populates in it an Ichimoku. Now, these are very customizable. You can quickly, this is the daily Ichimoku. I can, let's see. Oh, right here. Okay, so right here, I was clicking in the wrong area. So I can go and I can say, okay, well, there's the daily. It looks very bullish right now on the daily Ichimoku, right? Price is trading well above the cloud. The trend lines are all in an upward motion. Price is above the moving average lines. But I can go in here and say, well, where are we on the weekly? Aha, maybe slightly different picture, where we've just come out when I take a step back, okay, or elevate myself and look further back in time and look at the larger time frame. Now I can see a slightly different picture where we were actually just coming out of a bearish time in this stock. Which is true of many stocks through the year 2022. And now we've entered into a very bullish bounce, at least, if not a change in trend, and just about to break through, and in fact, just breaking through the cloud, coming into the positive side or bullish side of that cloud. So technical analysis can start to lead you towards a bias as to how you want to trade the stock. But let's not stop there. Maybe you are a technical analysis aficionado. If you are, you might have other technical analysis indicators that you prefer to use rather than Ichimoku or in addition to Ichimoku. If you are, go ahead and use your magic formula to predict a direction. Try to come up with a directional bias only because directional trades are the big winners if you're right about the direction. Not necessarily my cup of tea, if you will. Okay, next, use features at your brokerage's platform to learn more about the fundamental statistics and trends. Well, I use Thinkorswim, but all brokerages have extensive uh, uh, capabilities. I'm on CRWD. Let's go to CRM, okay? And let's go to fundamentals. Here we go. Fundamentals tab for under the Analyze tab. And then I go to the Fundamentals tab at Thinkorswim. And there is a ton of information here. Just a ton as I'm scrolling down. And we don't have time to get into any of this today. But here's where you can get the big picture of the fundamental analysis and statistics for the stock that you are considering placing a trade on it, as well as the earnings tab. And under the, by the way, under the fundamentals tab, there are no subtabs under the fundamentals tab, but under the earnings tab, there are a few subtabs. The compare, the fit all, and zoom. Okay, so there's a few subtabs. Again, we don't have time to go into that, but I think we did. I'm sure we did a webinar a couple of years ago that would still be in the archives. It's time that we do some of these webinars over again. It's, some stuff gets stale, it gets old, it gets forgotten, and it's way back there in the archives. Maybe I should bring this stuff back. Your suggestions, your comments about webinars and topics are welcome. Optionslam.com and gmail.com. Please send me an email. So anyway, back to our PowerPoint. Use features at your brokerage's platform to learn about fundamental statistics and trends. And when I say not, and I'm also referring to the earnings page and the earnings information at your brokerage. And if you don't have Thinkorswim, search Interactive Brokers also has great. I know that many of you who live in Europe and I believe Australia and other countries. I think Thinkorswim is available to some countries in Europe, but not all. But anyway, I think Interactive Brokers, I think is a very common brokerage house that people go to if they can't get Thinkorswim. Research articles about the company from the internet. Use Yahoo Finance, TheStreet.com, etc. I'm going to go back to fundamentals tab here at here, and so here's some. Here's some quick links built right into Thinkorswim, where you can go. This is TD Ameritrade's own research team, and here's the street.com. If you click that link, it populates in a new tab, and you get the street's quant ratings for that stock. And so here's a whole bunch more information. Okay. For you to get familiar with the stock you're thinking about trading. Okay, so do some what we call due diligence or research. Okay? And one other thing is in the earnings, here you can get a visual. I love charts. You can get a visual rather than looking at tables and graphs. Here's a visual chart, if you will, of earnings per share, actual in yellow versus Wall Street estimates. And this also can be helpful in helping you design or determine a bias. Now, don't forget though, just because a company beats the street doesn't mean that the price action of the underlying stock is going to be bullish every time, right? Because if we go to CRM and we go back to the earnings history page, we can see that about half the time the result is negative, whether they beat the street or not, right? So that's why at optionslam.com, we don't really pay that much attention. We don't pay any attention to whether a company meets earnings estimates, beats the street, meets the street, whatever, all of that lingo. We only pay attention to how the market reacts to the earnings event, regardless of whether the earnings were good, bad, or indifferent. Okay, moving on. Research articles about the company. Check out the stock social networks such as TradingView. Okay, TradingView is our partner, and they provide our charts for us, but they also have a community where chats about stocks and upcoming events. Really great stuff. You got Reddit. There's a bunch of others. Can't name them all, but look, you can search the internet for opinions and articles to develop a bias. Research on the historical reactions to the earnings release events at optionslam.com. See if you can develop a personal directional bias from whatever other means. Do you expect the next thing you need to decide before designing a strategy? Okay, the next thing you need to think about before designing a strategy: do you expect a large move or a modest move? You expect the underlying stock, the company that you're thinking about trading, a large move or a muted or modest move. Because again, we're picking a stock. We've already outlined CrowdStrike and Salesforce as a couple stocks. If you cannot find a directional bias that you are willing to commit to, then you can lean towards delta neutral trades. You can lean modestly in the bull or bear direction with many of the trades that we have been talking about here, misspelled, at the Option Slam webinars in the recent months. Okay, you can have, and we're gonna design some trades. I'm coming up here in just a minute. A few strategies to consider depending on your expectations. So, long straddle, a large price move with no directional bias. Let's do that once. Let's go to add simulated trades. We are on CRM. We'll go to the at the money strike, which is the 220 strike, and we'll buy a straddle. And as you can see, when we look at the risk profile, this gives you, if you think the stock is going to move big, really big, one way or the other, but you just don't know which way, this is a strategy that you can employ. However, I caution you, you are subject to implied volatility crush. And with a 13.5 Vega factor, this thing is not going to be pretty if the stock doesn't move. The stock needs to move. It needs to move big for this to be a winning trade. So it's a fallacy out there in YouTube land that, oh, just buy a straddle and then you can win no matter what the stock does. Not true, because the stock needs to move big for this strategy to win. Well, let's not spend any more time on that. Let's go back to our long straddle. Large price move with no directional bias. Back ratio. Large price move with directional bias. Well, let's do a back ratio just so you can see what it is. I'm going to do a bullish back ratio, and I'm going to go buy a back ratio, and I'm going to go to the, I'm just going to take a guess at where I want to be here. Yeah, that wasn't even enough yet. I really want to get this so that it is a credit trade, because I like to design a back ratio so that it does not lose money if I'm wrong about direction. So that's going to be a little hard to do with this one. There it is. But now I really need a big move in my direction. If I don't get a big move in my direction, then I kind of hope I'm wrong about direction, because then at least I make 82 bucks if the stock goes down. Okay, so that's how you want to design your back ratio, with a credit. See right here, a credit. Even if it's only a penny or a nickel, I want it to be a credit. Problem is, if I'm right about direction, I really need a big move, because again, I am long Vega. So I'm going to be subject to implied volatility crush. So moving on, other strategies. Short strangle, neutral with no directional bias. Excellent earning strategy. Maybe to some traders, the best. But as we talked about earlier, undefined risk and difficult to manage financially and emotionally if you have a big loser. And the big losers will come. They will present their ugly heads eventually. Even though you have a 70% chance of winning, don't forget, you're going to be exposed to that 30% chance of losing. And some of those losers may be big ones. Front ratio. This is the opposite of a back ratio. I really like this trade. This is something that I do common or often. It's neutral with directional bias. We can quickly illustrate that by just reversing this instead of, I think we can just reverse this. And then, there we have a front ratio. So a front ratio is buy one, sell two. Let me just do a front ratio quick, how I would normally set one up. Okay, quickly. All right, price is 220. I'm looking at the implied move. I can pick that up over at optionslam.com, or I can calculate it myself, but optionslam.com actually gives me the implied move for both for the weekly options as well as the monthly options. So if I go 9% on the weekly options, I can just take the stock is trading at 220. 220 times 9% is about $19.80. So that's 20 bucks. So I can simply go down from 220 down 20 bucks. Let's see, I need a few more strikes here. to the 200 and sell the 200. Excuse me, I'm doing a back ratio. I'm doing a back ratio. Let me do this differently. I'm going to go slightly above that. Let me just design one quickly here. I'm going to buy one and sell two. Buy one, sell two. The opposite of a back ratio is a front ratio. And so there is and then this is using the June 2nd, so that would be the front week weeklies. And there is a front ratio. This is a trade that I'm very fond of. It does have undefined risk. So be aware of that. But if the stock goes up, I keep my credit. If the stock goes down, I have a window of huge potential for profit, but that is very close to the danger zone. Okay, moving on. Front ratio. Iron condor, neutral with no directional bias. Or you can design your iron condors with a directional bias. But finally, getting to what I wanted to talk to you about is the SWIC and the risk reversal. So I actually did some screenshots and in preparation for this webinar of some setups, but rather than going through those, let's just design them live. The SWIC is the single winged iron condor. It does have a undefined risk component to it. So let's start with that, and then we'll move to the risk reversal, which we just talked about recently. So let's talk about both of those strategies. We'll use CRWD and CRM. Okay, back to our let's see, CRM. Okay, well, we're here with CRM. Okay, let's look at a single winged iron condor and see how that would work out. Now, bullish or bearish or delta neutral. Using these strategies, I am not super bull. I am not expecting a huge move. If I'm looking at these strategies, what I've determined is that I have a slight modest bias, either bullish or bearish, and we'll design the trade either way to accommodate you and what you decide after doing your analysis, technical, fundamental, internet searching research. Okay, but just to show you, but neither of these are going to be. So let's just go at it. Let's do the single-winged iron condor. So with the single-winged iron condor, I like to first determine the implied move. I can pick that up over at optionslam.com, or I can just use the my broker, Thinkorswim, actually gives me a number. They're saying about $21 move. We just determined about a $20 move based on OptionSlam. And then they also offer a market maker move. So there's all these different numbers you can choose from. $21.26, $21.83, $20 from the OptionSlam. They're all hovering right around that 200. So they're all kind of pointing to that 200 strike. So I'm going to go ahead and sell that 200 strike. Okay. And then I'm going to go out of the money also about one implied move, one standard deviation, or the width of an implied move, which is about $20, to the 240. And I'm going to sell a vertical spread there. I'm going to sell a vertical there. So I'm bringing in 47 cents for the vertical. I'm also bringing in 268 for the naked put. Gives me the single winged iron condor trade. And if I do these together, by holding down the control key, it puts it all into one order for me for a total net credit of $3.18. Now, if I take a look at that trade in risk profile, you can see that the maximum profit is way beyond one standard deviation out to the end of the week. But even if there's an overshoot on the top side, I still have a small profit of $68. My max profit is the 318. And even if I'm wrong about direction and price goes towards my danger zone, I still can make maximum profit all the way down to my strike, which is the 200, or some profit is available all the way down to 197 zone, down to the 197 zone. So, okay, so there's a single winged iron condor in a bullish fashion. The same trade can be done as a bear. Let's uncheck that. And to do that as a bear, I'm going to sell the 240 call, and I'm going to sell a vertical, holding the control key down. And we'll take a look at the risk profile, and there is the single winged iron condor. And I call this bearish because I make money for sure if price goes down with this strategy. And even if prices goes the wrong way, so it's delta neutral to bearish, I still make money, but the danger zone is to the upside. So that's why I consider it a bearish trade, because the danger zone is to the upside. Okay, and there's nothing but good things can happen to me with a down move, as well as a delta neutral move. Beautiful trade, beautiful trade. Love the single winged iron condor. Love the single winged iron condor, and very high probability of profit. In fact, if you want to slide this over to the break-even point, you'll see that there is a 98.75% theoretical probability of profit with this setup. Okay? Again, not a recommendation, but something for you to consider. And you can tweak this to bring in, let's see. Well, we don't have time to tweak right now. We'll have to come back. Please send me some emails. Tell me what you want me to expand on. Covering a lot of information, a lot of ground today, and we're leaving a lot of information unsaid and unexplored. So where do you want me to dig in deeper? OptionsSlam.com at gmail.com is the email address. Where would you like Marco to dig in deeper? We've covered a lot of stuff here. So let's go over to another stock and another strategy. CrowdStrike. CrowdStrike is trading at $159 today. And a new strategy that I just recently brought to the table, and this one does not have undefined risk. This is a defined risk strategy. It is what I call a risk reversal. Now, some people call this a risk reversal, and I'm going to show you what many people call a risk reversal. They'll say, buy a call out of the money and sell a put out of the money, and people will say, well, that's a risk reversal. But I would agree with Thinkorswim and title it something different. A combo. This is a combo. This is not what I call a risk reversal. I went into that in the last webinar. I believe it was the most recent webinar. Instead, that's the components. That's part of the components of a risk reversal. Instead, let's do this. Let's design a bullish risk reversal on CRWD. A risk reversal, in my definition of that strategy. Let's see, what is the implied move? It's about $17. So I'm going to go out about, actually, we're kind of running out of time here. Let me refer to, I think ratio, SWIC, risk, okay. Did I do this? I got a couple here. Oh, that's on CRM. I wanted to do this on CRWD. Never mind. I was going to show you some screenshots I took before. We'll just build this. We'll just build this ourselves right now. So what we want to do, let's do the bullish risk reversal on CRW. I did this already, but I did it on the other stock. So that's all right. No problem. I'm going to go out about, I'm going to get started at about half of the implied move. Okay, that's where I'm going to get started. And then I'll tweak the trade once we get it populated on the screen to fit my liking. Okay, so I'm going to go half the implied move. I'm going to go about $8, $9 out of the money. So the stock is trading at 160. I can go to the 167.50 and buy a vertical. Okay, I'll leave it at, since that it happens to be the 250 strike, I think I'd rather be $5 strikes, but I don't like that. I'd rather be the 65.70. Well, let's just build this anyway. Let's build this the way, let's build this this way right now. All right, then we'll go out of the money. We'll go to the 150 and we'll sell a vertical down there. So you see what's happening is we're buying a vertical, we're spending money, we have a debit trade. And then I got to tweak the strikes here a little bit to make this a credit that will more than pay for our debit. I want a credit that more than pays for the debit. So I have a net credit on the trade. When I do these two together, I create a risk reversal trade that looks like this. I love this trade. It is a directional bias. Don't forget, directional bias is where we win the most money if we're right about direction. But what I like about the risk reversal trade is that I don't have to be right about direction. I can still make money even if the price goes down all the way to 1 standard deviation before I start losing money. Designed properly, this trade makes money if I'm right about direction. If I'm wrong about direction, down to 1 standard deviation, and only loses money if I'm really wrong and the price goes way down beyond 1 standard deviation. But the good news, even then with that, is that it is a risk-defined trade. And I know the worst thing that can happen to me is I could lose $268. That's the worst thing. It's not undefined risk. It is a defined risk. Another thing about these strategies is they're highly adjustable. They're highly adjustable. Okay, so you can if you're wrong, you can work this trade to reduce your maximum losses to some better picture and maybe even turn this around into a winning trade. So there is a risk reversal with the bullish bias. And let's do another one. Let's do another one with a bearish bias. Again, I'm going to go out about half of the implied move. So about, let's start with this, and let's buy a vertical on the put side. Okay, so and we'll go, let's do a little wider here. Let's go 150, let's go down to the 147. Let's buy that for $1, okay? And then let's sell, let's see, the 150, 60, let's sell this vertical, the 170, 75. Perfect. Perfect. There we go. Now we have a trade that doesn't make much money if price is flat. But if I'm right about direction and CrowdStrike has a negative reaction to its earnings event and moves beyond the 1 standard deviation, I can make a lot of money. Even if I'm wrong about direction, I still bring home $17, enough to pay for commissions and a cup of coffee, a cup of Starbucks anyway. Which, by the way, I don't know if I told you, I've never been inside of a Starbucks in my life. I haven't sworn off it. I've never had a cup of Starbucks coffee. I just say that because I heard a rumor that it's like $10 to get a cup of coffee at Starbucks. Well, I drink tea and I make it at home. So anyway, there's the risk reversal in the bearish bias mode. There you go. You can tweak this any way you like. You can tweak it and make it so that this doesn't have to go beyond 1 standard deviation to get, there's always give and take when you're designing option strategies. You give up maximum profit to bring the probabilities of profit in closer. Things like that, right? You always have to give something up to get something. If you don't like this maximum loss, well, then you have to you can tweak the strategy so that the spread isn't so wide, but you're going to give up something on the other side. All right. Well, listen, that is it. That covers the webinar for today. Thanks everybody for being here. And thanks for your patience with the snafu yesterday. Sorry about that, but power outages are definitely one thing beyond my control. I do have a generator, but I don't like to run my computers on it, okay? Because it's not real clean energy, and my computers are fairly sophisticated pieces of equipment, pretty expensive stuff, and I don't like to run my computers on generator power. I'm looking for a new generator that does a cleaner job, and then if I get that in place, well then power outages won't be a thing in the future. But for right now, the generator I have is not conducive to clean energy, as they say. All right, very good. Thanks everybody for being here. We're looking forward to seeing you again in the next webinar. Goodbye for now, and good trading.